All right, we are live. Welcome back, ladies and gentlemen. We are here on a special Thursday night edition, which is why I'm holding my mic like this. I feel like a radio broadcaster, a singer. We got 48 people here already in 15 seconds. Thank you for being here. Palantir Weekly is not happening tomorrow night. It's happening on Thursday night.
Because we're broke.
Because what?
I said because we're broke, but
because we're broke. Yes, because we're broke. No, we're doing a Thursday night special. Look, we had earnings on Monday. Very special week in the Palantir community. Some top line news. Very controversial week in the Palantir community because not everyone liked earnings. Not everyone thought earnings were that good. But nonetheless, the market liked it. Stock rallied to about $10, a little bit over $10. Now it's down at around 9:30, 9:40 after hours on Thursday. But we got to break it down. So this is going to be a good earnings special, and we're going to break down everything, numbers, qualitative stuff, everything that we need to get into. We have Matt Money with me, OG member of the pod. We have Grogu, who I think this is their second time on the pod. I think they did the pod a long time ago. Grogu, for those that don't know, is a huge Palantir bull. I think their entire portfolio is in Palantir, pretty much. A little bit of crypto as well, but they'll speak on it. I did an interview with them a while ago. They were in Tesla in 2018. And now they are pretty much all in on Palantir, and they are on Twitter, and their Twitter's in the description, so you can check them out. They tweet a lot about Palantir. And we have Chris, who will be here in a couple of minutes, and we'll talk about why Chris was late when Chris gets here. Palantir Weekly. First off, I just want to get some raw thoughts from you, Matt and Grogu. Instead of getting super deep into the numbers, how did you feel this week as a Palantir shareholder as we hit above $10? Let's start with you, Matt, then we'll get to Grogu.
Sure. I mean, I was pleasantly surprised, right? So I was under the assumption, that we've been kind of hovering around GAAP profitability. We've been non-GAAP profitable if you remove the share-based compensation piece, but the actual GAAP profitability was a surprise, I would say, to me. Obviously, I think it was to a lot of people, which is why the big bump. But it just gives you further confidence that we're getting closer and closer to things going in the right direction to an extent. But what I will say is that was partly, if not fully offset, that excitement was partly or fully offset by the continued revenue slowdown, which I think a lot of people highlighted as the negative side as to what's going on. We've gone from things going up 50% year over year to 30%. Now we're, kind of hovering below 20%. What's going on? Are they sandbagging? Are big contracts that were expected not coming in? And I think a lot of people have these questions. And so that's kind of where I lie it, right? Positive, but that fully offset by what's going on with the revenue,
Okay, Grogu, your kind of raw thoughts as you saw earnings and saw some of the price action this week.
Yeah, for me, it was a surprise as well. I didn't expect profitability, but then again, that was to some manufactured in its own way. I was mostly just focusing on clients. That's all I really care about right now because as the clients grow, the more word gets out about Palantir, and I think the revenue will just show up. I know it's a bit manufactured, but I do say this thing. If you're going to say manufactured, you have to understand that the money that went into that investment that they pulled out of was also money they already had. So if it didn't actually, it was already sitting there. So it's still there. It's not like it's debt. They're debt free. Like I think they could have been profitable even like a few quarters ago. It wouldn't have been a problem. It's just they're choosing not to do so, and they're choosing to do so earlier. And I think it has a lot to do with the fact that the trading market likes these news and it affects the price that way. So possibly they did it for that reasons. I'm not sure, but not going to complain. I'm okay with it. But I do think a lot of Palantir holders did overreact about it. Like I didn't care too much about it. What I cared about was the client growth, which was 55%, is what I'm mostly focused on. But those are my raw thoughts.
And Grogu, for those that don't know you in the Palantir community, can you give a little bit of introduction of who you are and kind of how big your position is?
Well, position is. I mean, I don't want to get into numbers or anything, but like it's 100% of my position. I don't have any crypto.
You already told me your numbers on the podcast we did a while ago.
Yeah, it's bigger than that now. So
oh,
just
wow,
kind of been adding. So, but yeah, for individual investors, pretty good. And I think this is. I do think Palantir will be my last investments that I make when it comes to one of those big wins, because it's hard to find a good company for the long term. You're not going to get another Tesla or ETH or any of those kind of run-ups unless you actually have insight on it. So after this, I'm going to start playing conservative. But
and do you think Palantir is comparable to those sorts of investments that have played out very successfully for many people on Twitter and YouTube?
Yeah, I feel it is. I'm more convinced on Palantir than even Tesla and Ethereum, like because I've never put so much capital in my, and mainly because I think those are just silos of like Tesla is just silo of the robotic, whatever, like cars, and then ETH was just financial sector. My whole understanding of data is that you need governance around every single database, and Palantir could just easily sit on top of both of those sectors and just like carry its own. Um, it's in its own league, in my view, and I think it's going to play out really well because the TAM is just going to keep growing based on the amount of data that keeps growing. And as we already know, with sensors coming on board and all these companies requiring data management, it's not going to slow down. It's going to continue to grow, and you're going to need some sort of software that connects all sectors together. And I think this is all we got.
Okay, so we're gonna get deeper into your conviction, Grogu, because again, you are one of those people that, in a world where everyone complains, you basically tell them to shut the fuck up and stop complaining because of how much your conviction is, which is why I love your stuff so much. But before we get deeper into that, Christopher Patel,
Hello,
can
Chris.
you tell the chat why you are late to our Thursday night special Palantir Weekly?
Because you never emailed me back. You said, "Oh, Chris,
Hold on. Did you just say email? That's how I know
or texted me back." You said texted.
Email. What
Twitter.
is this? 2008.
I looked. I was like at 9:00. I didn't see any messages from you, so I was like, "Oh, you know what? Maybe he's not doing it today. Maybe it is another time."
No. You know what we're about to do? How do I?
Have to put you on blast as well.
Go right ahead.
There we go. Okay. This is Chris. I said 4:30. I said, he said, I'm down for tonight, 9:29 a.m. I texted you back. I was like, all right, can we get Matt? I'll ask Matt, blah, 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 boom.
Yeah, so but you didn't follow up. Good.
You know. Gracious. All right. Anyway, thank you, Chris, for being here. Chris, we're really excited to have you here. I wasn't going to do the thing that I'm about to do until you came here. So I'm so happy that you're finally here because now I can
No. Mute that.
Palantir is profitable, baby.
Listen, it's a little bit of accounting gimmicks, but sure, they're profitable based on accounting.
All right, so let's get into
that. Lambo,
Chris, what were your
Lambo?
Yes. So Chris, you were with me on the earnings live stream. What are your raw thoughts now that you had a couple of days to digest it, and as you saw the price action this week?
I mean, they're headed in the right direction, but they're not necessarily in the greatest of shape. What a lot of some people are getting a little ahead of themselves with regards to the bullishness on it. The numbers were not like, oh my God, like rip your face off rally where they were gap profitable based on, pure metrics. Like, yeah, they had some accounting things that worked out in their favor, which is good. You want to invest in businesses. The question is now, are they going to be able to keep that up and keep it growing? Yeah, you're gap profitable because of some accounting magic, but what about next quarter and the quarter after that and for the year? Are you going to be able to sustain that? The last thing you want to do is go 1 foot forward and saying, oh, we're gap profitable. And then next quarter, you're like, oh, well, you know what? We're not gap profitable. You don't want to take a step back. So I don't know how I should feel about it, but I would just say to a lot of the Uber bulls, just be easy with it. Don't go too crazy. Just be easy with it. And especially the thing that set me a little bit back was that a lot of the other names that are very speculative also rode up at the same time. So you had the Upstarts of the world, the Affirms of the world. When those started riding up also, which are highly speculative names, it gives you a little bit of hey, is this naturally something that's happening to Palantir, or is this just a market-wide thing? Who was I messaging on Twitter? They were asking me about my opinion on it. And I said, well, you know what? If the other meme stocks hadn't rallied at the same time, I would have believed that this is something more of institutional money getting in the door, but it didn't seem like that. It was a lot of, and the other thing is I looked at Wall Street Bets, Palantir had jumped from one of the bottom stocks to one of the top most mentioned stocks within the 2 days, 3 days after earnings. So those are the kinds of things that you just have to ask yourself, what is driving the price higher today? Is it actual fundamentals? Is it institutional investors? Or is it retail just going a little crazy on everyone's favorite retail name? And remember Palantir is a very retail heavy,
Yeah, 53%.
heavy stock. So yeah, I would say this is a good thing. Palantir is headed in the right direction, but don't go crazy with it. Don't be like, okay, from now on, I'm all in on Palantir forever. I saw even on CNBC, there was a couple of guys, they're like, this is a generational opportunity that you don't want to miss. And I'm like, dude, that's like every other stock in the stock market. Like everything's a generational opportunity. Just be good with investing. And
Yeah,
this
I
is
agree.
yeah. Go ahead, Matt.
Well, I was going to
Yeah.
say, I mean, the thing you kind of hit it there is like the thing that I think was most surprising with everything. I mean, I wasn't surprised revenue to come down. I wasn't surprised for one quarter of gap profitability. I will say, the thing that did surprise me was all of 2023 is expected to be gap profitable. And I'm with you there. I was kind of like, are you really trying to promise that? Is that because the next thing you know is we come in at 1 cent under, or we come in at flat, or we come in at 0.01 negative EPS for the year, and we get smacked in the face. It kind of, I don't want to say sets you up for failure, but it's like, to me, I would sandbag a little bit. Like, you gave yourself 2 years. It's like you got one quarter. Like, give them a little taste, but don't give them everything, because now I think a lot of people are expecting the moon. You see all these people revaluing the stock. It's a buy. It's, people are saying it's going to go to 15 to 20. You see all these re-ratings happening. And like what you guys said, like the pendulum, I feel like has swung completely to the other direction, where everybody was expecting Palantir to go to zero. And it's kind of like, I think everyone recognized from a cash flow perspective, we didn't think that was going to happen. We knew that we had $200 million a year kind of coming in from a free cash perspective to go back to the bottom line, because we went from 2.4 last year to 2.6 this year. But I don't think anybody else a lot of people that are bears on the company realize that. But yeah, to overextend and say, oh yeah, full year 23, it's going to be fully profitable from a gap perspective. I think
So
maybe they could have held off until 2Q.
Yeah, I just want to follow up on what you're saying, Matt, and officially start the discussion there. So Palantir became profitable essentially on an accounting gimmick. It was not from operations from investing. They actually had a loss there. It was from a step acquisition they did in a joint venture in Palantir Japan. I still don't even know all the full details, but that is what produced the profitability. And then they cleared up some of the SPAC names, and voila, you get $31 million of net income, which led to the gap EPS. So here's the question I want to pose to the panel, and I want to start off with you, Grogu. Was this accounting gimmick a fiscally irresponsible thing to do because of Matt's concern of like, what if you don't end up being gap profitable and then you have to end up going backwards? Like when Tesla became profitable, it kept going and it kept being profitable. So like this is a big risk. Or do you think management did an accounting gimmick because they know their future growth is going to be strong enough to justify true gap profitability, and they wanted to show Wall Street and shareholders that they're turning a corner?
Yeah, I think it's the latter. I think they know what they're doing, and they're going to figure a way out to just show it. And I think the key for them is to be minimally profitable. They don't have to be extremely profitable, just enough to show that, hey, we are profitable. So shouldn't expect like amazing grab profitability. It should be just like enough. So if the estimate's like, it was like by a little bit that they beat it, right? So I think that's what they're going to try to do every time. And even Elon said in early days of Tesla that our goal is to become minimally profitable and have a lot of cash flow and just onboard and then pretty much spend a lot of money in the early stages. And I think that's what they should aim at. Don't go for too much, just enough to just kind of get you by so you can just say you're profitable. And I think in 2023, they will continue to do so. I think they have that planned out. If they don't, then I don't know. I mean, Alex Carp did say 25, they're going to be profitable, but you came out earlier. So what if it doesn't, right? I mean, I wouldn't be too, like Chris said, like you shouldn't be too optimistic or crazy about this profitability stuff, because I think the key is still to be focusing on the growth of the company. Which is
why do you think they did the accounting gimmicks then? If they gave themselves till 2025, what was the point of it at the end of the day?
It may have something to do with just the bear market, that maybe nothing is working, so they just thought maybe we'll just that because we can. At the end of the day, the investment's still investment. If I invest into something and it goes up or down and I take that off the table and I use that as profits, it's still profits at the end of the day, because you didn't really lose any money. Unless I'm getting something wrong here, you guys can let me know.
I don't like the word gimmick. personally. I mean, I think it's
Yeah.
reality, right? Gap profitability is gap profitability. Just like I don't really give a crap about gap profitability. I'd rather look at the cash flow statement and look
Yeah.
at that, which is why I've been such a huge fan of the organization in the first place, because I know they're making $200 to $400 million in free cash. Gap profitability, like you take all these one-off tax items and stuff like that, just like the SPACs and stuff being written down. It's like that's not actually hitting the bottom line. Like, anyway, sorry, I didn't mean to steal the comment.
No, you're making a good point there. I look at it, I have a portfolio and I have some investment that don't do well. If I'm up 200% and then I take something off the table and I can use that and show the government that I made some money, like, does that mean I'm not profitable anymore? Like, that's the whole point here, right? So it's the money they already had. I don't know what the details are with that Japan Palantir, to be honest. I'm not gonna act like I know. But if someone can actually dig into that, like what that is and how that worked and where did that money come from, and if they lost money or gained money on that, I'm not sure how that is. I would love to hear from you guys.
So and I think this is, if you could highlight that message from Jay, Amit, I think he nailed it on the head. Exactly what I was thinking. So they needed to take some of the stink off of their poor guidance. Like a 15% guidance on this company is very poor, considering that literally 2 quarters ago, you were projecting 30% growth for the rest of, I think, the next, like, however many years that they had said, which is really bad. Right. So if you now have to guide for a 15% growth, you better have something ready to counter that stink. So that's what happened. They basically, like, I don't want to call it a gimmick. It's not a gimmick. Okay. They actually had real tangible accounting, like, things that went in their favor. Right. But it does feel a little bit disingenuous that they came up with it at this specific time. But that's not to say that other companies don't do that. A lot of companies do it. Don't think that Palantir is unique and they're trying to hide something. They're not. Every company does it. There's companies out there right now that'll mask all sorts of, like, gains, and then when you really look at it, it's just literally like accounting gains or accounting losses that they're using to project things out. I think the bigger thing, and really, people, I gotta say this, because the Palantir community, I'm going to look at the camera to say this. You guys need to stop hating on people like Jay for stating things that are actually factual. Like, I saw so many people attacking Jay for even mentioning the parts that actually are relevant, that I get it that you can be an Uber bull on a stock, but don't take every single thing that comes up that's slightly critical and turn it into, like, oh, Jay is a Palantir bear. Like, he doesn't care about this guy has done more research on Palantir than most people, like, will ever do on Palantir. So I would say give some of the people a little bit of a break. Even Uber bulls need to Uber bulls need to just calm down a little bit and relax. Like, don't make things personal. I've never blocked people on Twitter before, like, the last, like, 3 or 4 months, where people literally started saying shit to me personally, coming after me personally. Like, dude, you don't need to do that. Like, that's like, this is supposed to be a community that's full of, like, thesis, people bringing out the good, people bringing out the bad, but never take shit personally and actually throw people like that. And so I'm like I said, I don't want this community, because I am still part of this community. I launched it right with Amit when Palantir really started.
This podcast was Chris's idea. Let's not forget that.
Yeah. And I just, like I said, I just want this community not to turn into, like, a toxic community where literally anyone who has an opinion that counters the bull argument gets automatically, like, shunned and thrown into, like, this whole, like, vacuum of things. Like, bro, everyone is allowed to be goddamn critical. All right, relax.
Yeah,
No,
you're making a good point, Chris, and it's good to highlight this point for a second, because I mean, there's 200 people here, 198. I mean, this is, if you're showing up on Thursday night, this is kind of the core community. I know there's obviously a lot more people that follow the stock, but this is a core community here, and I think it's a good point that when we're making online digital communities, people who are critical of things of a company do not need to be demolished for being critical. I mean, there's so many people in the Tesla community that are obviously critical of Tesla, but at the end of the day, they'll have love for the company, still believe in it. And, you know, that's what makes a healthy community. If you don't have people coming back, and you don't need the Gordon Johnson type of idiotic arguments, but you do need the Gary Blacks that are putting really solid criticism out there when it comes to the company that they have massive positions in that they want to see do well. And I agree with you. There's no reason to be critical. I mean, Jay started a Twitter space that the night of earnings, and I hopped on and we talked and we had discussions and a bunch of people were there. Sachin was there. He was echoing a lot of the same claims, and Sachin is 101% in Palantir, and he has the same, issues with guidance as well. So I agree. We got to keep the community not toxic in order to make this work.
Yeah, I agree as well. But there's some things that I kind of like look at and I'm just like, okay, let's just really drill down before we actually start making these claims.
Okay, cool.
I mean,
So let's get into the fun stuff then. So what were
yeah,
some of the stuff that people
we
said
can't.
that made you really annoyed?
Like, I'm not a person.
And again,
I don't
not annoyed
hate
on a
anybody.
personal level, obviously, but from an
Yeah,
argument
not at all. It's just stuff like, okay, like Alex Carp talks like he's high. I'm like, no, he doesn't. I've seen. I'm
a shot at
I'm
you,
in
Chris.
Canada, dude. I'm in an area where they smoke weed 24/7. I can tell you what people talk like when they're high. Alex Carp is the complete opposite of that. And if he was high all the time, I'm telling you, they would not have this guy talking to government officials. That would be the last thing they would be doing.
I never said Alex Carp talks like he's high. I said
Not you.
If there was okay, but I said if there was a person that I want to get high with, it would definitely be Alex Carp because he would be awesome with it with his philosopher degree, bro.
Philosophy,
he'd be awesome. He's like, man, those goddamn Russians, I'm gonna goddamn get them. I got these satellites working overtime. I'm gonna get them.
Ontology.
Let me figure out the ontology way to goddamn take out all these Russian tanks.
That's why when he needed somebody to be CEO, Peter Thiel was just like, I got the perfect guy.
I got the guy. Grogu, was there anything someone said about or any statements said about earnings that you didn't really agree with that you thought was not the best criticism?
I don't disagree. I didn't get too excited about it because if you look at my tweets, I probably have one tweet about profitability, to be honest. I was just excited about the growth of the clients, and that's pretty much it. But I was also not a fan of the fact that the reaction of other people getting excited and the people coming out saying that, oh, they're not profitable. I mean, great, but at the end of the day, it's still their money. Like it's still within their balance sheet to do whatever they want with the capital. So you can call it whatever you want, but if they didn't have profit, if they didn't have the money, you can't money just doesn't pop out of nowhere. You have to somehow figure out a way to show it on the balance sheet. And they did that. And the transparency of Palantir is what's actually making them actually look like they're the hidings, but they're not. It's right there in front of you, and they're letting you criticize if you really want to. And a lot of people are thinking that people are stupid because Palantir's trying to hide stuff. No, if they're trying to hide stuff, it's right there. You have to show it. So
Grogu, I totally agree with you. I thought the best thing that I saw in the entire presentation was the client growth. Yeah. I've been harping on this for ever. Grow the number of clients and the revenue would fix itself. If you look at it, to grow 55 companies during a recession to get them onboarded onto your product, all those people that said, oh, Palantir is not scalable, including myself, now I have to walk that back. Right. And say to myself, wait a second, how are they expanding to so many big name companies? Of course, they're figuring out how to scale. And this quarter shows it. It's almost like the Elon moment where it's like, oh, you can't build electric cars in mass. And then guess what? The minute that they start building electric cars in mass, everyone's like, oh, I guess you can do it. So I think this is one of those moments where Palantir is just a consulting firm. Well, guess what? Consulting firms don't grow at the rate that they're growing. So
yeah, there was a question I had in the report. I don't know if it's I guess you can call it a concern. They never show the average sales price across the board. They always do top 20, and I'm always curious why they do that. And I think they should show all of it.
I think it would be too high. I don't think they would want to show it because it would still make them seem like they're too elite or whatever.
Would it be lower because it said 49 million? I think they said for the top. Just correct me if I'm wrong. Is it?
It went from 44 to 49. Yeah.
Yeah, so that's top 20, right?
You also don't want to give off pricing with regards to the. I mean, technically, if you're smart enough, you could do some good math and figure out who's paying what, and then when you're negotiating your contract, you could probably negotiate for a really low contract rate. So I think they have special contracts that are tiered with certain entities, and the thing is, if they broke it down too much during a sales meeting, they'd be like, oh, you're overcharging me or you're undercharging me. So, you don't want to typically break the numbers too granular, and then you have a problem dealing with sales. You want to keep keep very like mysterious, so that when you go in to make a sales, you look at the client and say, okay, how much money can they afford? And then also at the same time, how much money are they willing to spend? Because if they're willing to spend more, you're not going to say, well, you know what, it's okay if even though you're willing to spend more, you can spend less, because our last client wasn't willing to spend as much to do the same thing that we're trying to do with you guys.
Yeah.
But I am
It'd be
curious,
nice
though.
to see.
Sorry,
Sorry, go ahead, Matt.
No, I was gonna say
Oh,
I agree with you 100% because I'm just doing some math here. So 49 million times your top 20. So let's just say that's close to half of your revenue that's coming in for fiscal year 22.
Mhm.
That means the other 400 some clients are providing the other 50% of the revenue. So I'm that increase year over year is a 10% net dollar retention, or 110% net dollar retention. You're able to retain those 20 clients and also grow it by 10%. But it gets me to think, like, in order for this thing to really start kickstarting, right? Like, you have these smaller clients that are coming on at $1 million, 5 million, 10 million. And it's like, what's the NDR for that? Is that in the 140s? Is that in the 150s? Because you see the 10% growth. I can understand if you have a big top 20 client, that's not going to grow as much because those have already kind of gotten to the scale phase where they've already kind of gotten to as pulling as much revenue as possible. Those are the Hyundais of the world, the BPs of the world, those sorts of the clients. But these new guys that you're getting on at the 1 million, 2 million, and you're hoping to scale them and grow them. I'm really curious what the NDR of those is, because that's the other 50% of your revenue base. And if you have 400 some clients, and that's growing at, say, I'll just throw a number out there, 200% NDR, then it's going to look very differently than if you're only at like a 110 or 115 NDR. And the fact that they're only showing the top 20, I don't want to say it's bothersome to me, but it just goes to kind of show. It's like it would allow you to kind of understand how much is because you're getting new clients, how much is the fact that you already have existing 300 some clients that were in the year that you're growing that net dollar retention, and how much it was because you added 50 clients, right? And it kind of gets you to understand where the dollars and cents are coming from, because there's 3 different avenues there. There's the big top 20, big scale. There's the people that are still growing. Then there's the people that are just getting in the door, which will be growing in, say, the next 2 years or 3 years after the fact that they've just gotten into the company.
Okay, here's the question I want to pose. All right. Do we think they are sandbagging growth? Now, a couple things. We as investors cannot make an investment off of the assumption that they are sandbagging growth. I think that would probably be an unhealthy way to invest. However, as you said, Matt, when you're talking about NDR and you don't want to give away certain numbers, I mean, look, they said 30% CAGR a couple quarters ago. They CAGR'd government for the past 10 years, 30% year over year, even though some years it was bad, some years it was really good. Do we think this is another scenario of that? And second of all, Datadog put out some of their earnings today, and their guidance was really below what the street expected. And a lot of people that I follow that are heavy in Datadog on Twitter, their first word that came out of their mouth to describe earnings was sandbagging, because they could not believe a SaaS business could have that little of growth. So what do we think? Are they sacrificing profitability for growth? And do you think
I'll go first? I'll go first on that. I do not think that they're sandbagging. I think they're trying to be as real as possible with investors as they possibly can be. And the reason for that is because we are headed into a recessionary environment. Like, you look at AWS growth has slowed down significantly because every company right now is trying to cut back on spending on things that are non-critical to business operations. A lot of products that are non-essential for business are discretionary. And so if a company's like, hey, listen, I can either keep employees or keep this software, which I don't know whether it's delivering any value or not, which one am I going to keep? Of course, they're going to try to retain the employees, right? So a lot of those factors are starting to make their way into the general market. I mean, all these people right now, companies are taking dramatic steps to right-size their ships, even if their business hasn't deteriorated yet, in anticipation that businesses are going to deteriorate. Like, look at all of tech. All of big tech is still profitable. They're still generating billions of dollars, but they all realize, hey, listen, a slowdown is coming our way. They're some of the smartest guys in the street. They're like, no, we need to cut back on employees. We need to cut back on headcount. We need to cut back on spend because we don't want to have all these additional people twiddling their thumbs and we don't have enough work for them coming into the future. So I think a lot of them are just front loading the expectations. because the recession is on its way. Like, it's almost like people are batting down the hatches and getting ready for it. So one of the things that they're not going to do is just come out there and say, look, we could probably do this, but we're going to guide for this. So yes, there is an element of sandbagging, but there's also an element of realism in there also. Because the last thing you want to do is promise something that you cannot deliver in this environment, because you're going to get punished twice as hard as in the past. At least in the past, like, the market was very forgiving. You didn't have a 5 to 6% hurdle rate on cost of capital. Right now, it's a whole different ball game. Like, you better come with it, and you better come like honest as possible.
Mm-hmm. Yeah, I think another thing that I think I agree with the realism piece, right? So I think in the past, maybe that 30%, this is all me speculating, but that 30% annual revenue growth, I think, incorporated things like the NHS deal, which isn't necessarily a slam dunk anymore. And I think some of those things, while we've had positive sentiment based off of what's going on in Ukraine and Palantir being able to help out with that, and some of the obviously the help with the pandemic and stuff like that, there's still I don't want to say credibility problem, but the fact that people think that America is spying if they allow somebody like Palantir into their country, right? And you're giving the Americans too much power. You're giving somebody, but so I think that there's still this sentiment piece that obviously you're seeing the international revenue decline much worse than the U.S. commercial and the U.S. business declining, because that's what's basically holding up the revenue kind of going forward. So until you kind of get out of that sort of funk, I think you kind of have to be realistic with people to kind of show this is likely or something that could happen. Now, obviously, if the NHS deal comes in, then that's a 5% hit immediately in the positive direction on revenue growth, because it's going to be like $100 or so million a year in revenue. So I don't know, kind of. Anyway, I think it's realistic, the actual revenue piece. What I can't foresee as being realistic necessarily is the earnings piece, but the gap profitability earnings piece. But I think we've always been sort of so borderline on that anyway. It's not like we're going from a negative dollar EPS all the way to like it's like we've always been minus 10 cents, minus 15 cents. So it's not like we're going a magnitude different in terms of, trying to swindle anybody. But anyway, I think I'm kind of diverging from the question.
So no, that makes a lot of sense. And Grogu, before you answer, you were a part of ETH's run up, Ethereum, and Tesla's run up. And these are high growth. I mean, at least Tesla, right? It's just high growth. They had to produce real massive 60, 70% year-over-year growth to justify those premiums on the stock. You are very heavily into Palantir. Management is saying barely 20% year-over-year growth. Like, to you, as someone who's participated in really high growth companies, does that concern you, or do you actually think they're lying?
No, it doesn't concern me. I'm used to seeing companies grow at a slow pace and then eventually just take off. I'm going to give them 5 years. That's my time limit. So it's been almost 2 now. So 3 more to go, and I'm going to keep an eye. So my conviction goes up based on growth. So if they keep growing and they keep getting more clients, because I think that's where the actual value will come. So based on that, I will continue to buy. And if they start decreasing, then I'll load off some of the shares. So that's usually how I work. Conviction goes up, buy more, conviction goes down also. So I have like 2 positions as well. So no, I mean, not right now. Well, all I'm focusing on is the client growth. Also, in terms of the last question, sandbagging, I would say they kind of are, because my last point was that I think they have it all planned out, that they probably don't even have to actually beat the estimate, because analysts are estimating based on whatever they are getting guidance on. Even if they meet it and then just keep growing, that's enough. They don't need to overshoot the profits in any way. So I think they kind of are sandbagging. They have it all planned out for 2023, leading to 2024. And the goal of theirs should be, okay, show the profitability, but actually just get as many people on board as possible, because that's where your actual money is going to grow. And until people don't realize how valuable the software is, it's not going to grow. And for Ethan, Tesla was the same thing at the early stages. Not a lot of people actually knew what this tech could do. And I could raise this question: did anyone from any stock market know what ETH was capable of doing even today? Like, it's a technology that can carry on, do whatever Square or SoFi can do within a smart contract. But a lot of people don't know this because they don't use it. But I was the front end user of this stuff. So just based on that conviction, I think, yeah, Palantir will probably be a lot more powerful, I think, versus those two.
So you really think in the next couple of years, Palantir is going to have 60-70% year-over-year growth when it does hit the S curve? You believe that?
Yeah, I think the growth will be just coming from the clients. So the clients that they onboard will realize how valuable this thing is, and they'll continue to pay because each company will make so much money off of their own data, which they will be launching. So currently you have like stuff like Amazon or these app stores running on Apple. I think each company is capable of launching their own product using Palantir's Foundry. So like a bank can launch their own app. So if you have a competitor on the side, like Square or SoFi doing something, the bank can actually launch exactly what SoFi does using Palantir because now they know how to like utilize their own data. And that's where majority of the money is going to get made. So if you just have 360 clients today, it goes to 1,000. I think the money will pile up later, not now, but let them onboard the people first. That's my conviction.
So I agree with your end game with that they're going to be much bigger than they are today. I just think it's going to be a lot more of a slow trudge up rather than an S curve, because when you look at like the companies that traditionally have had like S curve moves, they've usually had something that changed in their organization or product that ended up giving them the ability to just scale really fast. Like, and the way that that typically happens is because you have something like manufacturing where literally you're just, producing more widgets and boom, you're selling them and they're hotcakes and everyone's just buying them and boom, you've hit an S curve where everyone is going. I don't necessarily see that with Palantir because enterprise software, the way that the purchasing works is that it's exceptionally slow. And then on top of it, you have to integrate it and everything else. So it's not one of those things that's just like, oh, X, Y, and Z got Palantir. Well, we need to get it too. And let's get it running in the next like 30 days. Like a lot of companies and organizations need to actually adopt and change up their culture, which makes the adoption process a lot slower. It's not to say that they won't adopt it, it's just that it's a lot slower. So I think it's going to be more like Salesforce in that they'll consistently grow over a long period of time rather than like grow slowly and then one day just wake up and they're accelerating on all cylinders. And, now all of a sudden the growth is just jumping. Like I just don't see that happening in the SaaS world. I see it in the enterprise SaaS world. Let me rephrase that. Unless they come up with a product that's super highly scalable, that you don't need to like do any integration work, that literally all you have to do is just download it into your company and boom, you're ready to go. Like it doesn't seem like that's the product that Palantir is selling.
Yeah, I mean, I look at it, they are onboarding right now, and I know what you're saying. It makes sense based on the current information you have today. But I don't think that's going to be the world later. I think what will happen is the data will just get piled up more and more and more, and people will need to learn how to utilize it to actually benefit them. And if one company can have an edge on the other because they can utilize their data better, just like when you make decisions today, if you know more about your sound, you can make sound decisions faster than the guy next to you, you're going to outcompete them when it comes to one-on-one battles. So it's just the competition is going to continue to get tighter. But if one company using Foundry can outpace the other, it's just this message is going to relay across the board. It's like, because of this, our company grew. We're willing to pay that much and we gained that much revenue because of this. That will resonate across the board and it will make people jump ship.
I do think that there's one part that there might actually be an S curve, and I think that's in the defense industry, right?
Mm-hmm.
Like right now, I think what happened was they were like this growing, and then they had that court case, and then literally they started growing their contracts. But now with this war in Ukraine situation, just opened them up to like so much more business. So I know, like I said, I don't see them necessarily growing S curve like in their commercial side, but I think on the government side, they could land a few billion-dollar contracts and literally just go crazy with it. That's always been an X factor that a lot of people don't necessarily take into account. Like this whole Meta Constellation thing, it's proving to be a very useful tool in Ukraine from what I'm seeing. Now, how much would the US pay to have that kind of technology be exclusively in their hands? I mean, you got a country that spends $800 billion on on national defense. Think about the value that you have with something like Meta Constellation. So I think at the end of the day, I don't see the growth like the S-curve growth on the commercial, but government, I could definitely see it happening where one day one senator wakes up or one general wakes up and says, we need to have our eyes and ears open at all times, from satellites, from all this other stuff. We need to get it integrated. Who can do it? Palantir can do it. Here's a $5 billion contract. Get it done. Let's go.
Yeah, and it's not just a U.S. defense. I think it could be something like a NATO entire thing, which then you're getting all of Europe involved. And, they've always been for the NATO-like countries, right? Ukraine might be a little bit of one that's sort of kind of in the middle, right? But anyway, one of the key things that I wanted to bring up a little bit, which I agree with you, Chris, so just wanted to value that. The thing that is in the back of my mind that bothers me, and there's like a couple points I'm going to bring up, but I'm going to push it back to the room, is like the thing that I just want to ensure is that we're not taking the fiscal year 23 GAAP profitability at the sacrifice of continued growth. I don't care about 1 cent of GAAP profitability. I would much rather continue the acquire phase of getting into another 200, 300 companies in fiscal year 23 than show 1 cent or 2 cents of GAAP profitability, right? Like that's not going to move the dial, because at the end of the day, it's still a free cash flow positive sort of organization on an adjusted basis. So that's one thing I wanted to kind of get out there. I would much rather them run it like how Tesla did, where they're expanding into new factories. They're not necessarily caring 100% about GAAP profitability, because they're still trying to infiltrate all the industries and get that aerial expansion. And then second, I think that one thing that I truly hope that the company considers doing is the slides that they present are pretty good. That shows some good transparency. I think you could have just one slide, even display it in Foundry itself, that literally shows the 3 separate stages of every organization, like each of the different sort of parts of the business, the acquire phase, the expand phase, and then the kind of like stable phase. And it's something as simple as just showing that graphic that shows quarter by quarter, just like they always do with everything, have it split up into 3 different time series over the past, say, 5, trailing 12 months, trailing 24 months, whatever you want to have, and how that revenue is expanding. On the very right-hand side, you have how many people have exited that phase or entered that phase. So obviously your goal is obviously to get from the acquire phase to the growth phase to the stabilization phase, right? So you'll hopefully see many people climbing the ladder over time, and you can kind of see customer growth coupled with the revenue and what percentage, because that would give you an idea as to how much pipeline, right? How many people, obviously the top 20 are in that stabilization, continued growth phase, and you can kind of get your NDR from that. So, okay, so those are going to grow at 5 to 10% per year. Then you have kind of like your construction phase, like those are growing at 30% per year. It's like this acquire phase. We've acquired 150 clients. Obviously, we're spending a crap ton of money. We're not making any money from that, but eventually you're going to go into this middle bucket, and then you can slowly start to gauge where the NDR is going and hopefully understand how that revenue is going to shift. And then eventually, at what point do they kind of... So I feel like you could almost have the earnings presentation of Palantir on one single slide and get a very good feel as how the company is running on a complete KPI sort of basis. And then thirdly, going back to the sandbagging piece, and I'll hand it back to you guys. I know I'm just kind of rambling on. The thing that bothered me a little bit as well about earnings, which we haven't brought up yet, is the 4Q to 1Q revenue is basically the same. So we ended up at like 508 or 510 or whatever for revenue for 4Q. 1Q is also going to be 508. If you just take the 508 and multiply it out by 4 quarters, you get to like 2.03 or $2.04 billion. And that means you only have to grow like another 5% year over year from, I guess, like total revenue growth to get to that 14 to 17% range that they're kind of growing at. So it's like, if you just keep earnings flat off of 4Q and just keep it flat for the entire year, you're going to end up at 2.03 billion. So you mean to tell me that that's only going to grow another 5% from where we were in 4Q? It's like, I feel like I'm an optimist at heart. I always have been with Palantir, but it's like, there has to be some sort of sandbagging in there, or just some assumption or knowledge that some big contract is going to go away, whether it's 2 big top 20 clients, or, they're assuming some sort of retention that's not going to happen from one of the clients or something like that, or they're
Right.
not going to get the NHS deal. But anyway, that's a lot of information I kind of just went over in 3 minutes, but or it's not 3 minutes, 3 points. But just wanted to hopefully open that up for the rest of you guys.
No, it's good. It makes a lot of sense. I mean, there's a lot of good points in there, especially this idea about the sort of annualized revenue and what that would mean for growth. Again, I don't want to have an investment philosophy off of sandbagging, but at some level, it just, I saw a tweet today that if they just get the NHS deal, 360 million pounds, that adds 4.5% revenue growth this year alone. So it would go from 17 to 21% just off getting that deal. Now, maybe they don't think they're going to get that deal given all the political stuff going on and they want it to be ultra conservative. I mean, the idea that they announced profitability when Carp said in August 2025, and all of our, me and Chris were there, our mouths literally dropped to the floor when he said 2025, because we were like, you went public in 2020. You're going to make us wait 5 years for profitability. Maybe if you can sustain really high growth rates, that would be awesome. But that was pretty shocking. For them to come out and show GAAP profitability, as Jay said, they needed something to hold up the stock. But I also think they are trying to be fiscally responsible. And if they can be fiscally responsible in a recession year and grow because of all the crazy stuff that's going on, especially with Russia and Ukraine, and use that as a catalyst, then maybe there really is a shot for them to grow and not have to give up GAAP profitability.
They also need to attract employees, right? And it's always easier to attract employees to a company that's growing than a company that's slowly like decaying, especially if majority of your compensation is based on stock, right? So that's the other factor. There is one thing that I think I know a lot of people are not accounting for, but it always like is in the back of my brain. New products. Like, the only way that I see them hitting some level of S-curve is one of two things. Of course, the government side, they get some really big contracts, but then there's always that X factor in that everything that they're doing right now, working with clients, learning, blah, blah, blah. What if tomorrow they came up with a product that's highly scalable, that's able to be integrated very quickly? Companies can just come and get into it, whatever, and then it ends up being a successful smash hit and people get in, like something like, and this is the one that excites me a lot, is Apollo, right? I don't know what the growth trajectory of Apollo is going to look like because they don't break out the numbers in Apollo and all this other stuff. But if that product is as scalable as some of this stuff that I'm hearing in the background, and that ends up being a core commercial offering that they can offer outside of just Foundry and Gotham stuff, and it's something that's super scalable, something easily integratable at a price point that's super affordable, and that becomes like a default thing for a lot of companies, that could be a huge growth driver for them. So that's always the biggest X factor with Palantir, in that if they release a new product that becomes an industry standard and it just super scalable, that would drive the stock to the moon. But as of right now, I don't see that happening just yet. But who knows? These guys are some of the smartest software engineers on the planet. I'm sure that they're figuring out things that we don't even know,
I'm with Chris on that. I think he's bullish on Apollo, and so am I. Mainly because I'm driving this FSD Tesla car every day, and it's like not a small drive. It's 2.5 hours, and I see what happens to data and how it improves. And if they can find ways like Apollo does, being able to make this car smarter without needing to kind of connect to its main database for upgrades, that's a huge benefit on Tesla's side as well. So if you believe in robotics, AI, and autonomy, Apollo is that software piece that actually adds to it. And the fact that they're using it in the military should be the conviction that this product actually works. But how much, I don't have too many details on that, like how much it's being used. But data, AI, robotics.
Speaking of military, let me share a quick clip, Grogu, and then you can comment on this. This is actually on your Twitter. If you guys are not following him on Twitter, please make sure to follow him. This is Carp for 50 seconds talking about the difference between theoretical and philosophical practices in philosophy. And I want this to transition us into a discussion about the military application of AI. The Financial Times just wrote a piece on Palantir and their use of AI. So we'll get into that discussion after.
Hold on. Let me go grab a joint real quick. Okay, go
This
ahead,
guy,
Alex.
this
Tell
guy.
us all about it. Tell
We are
us.
never gonna get Carp on this podcast with you saying things like this. It's just not gonna
Please,
happen.
I don't care about him joining the podcast. I want to join him. Like, just get high. And I don't smoke, by the way.
I
don't
care
get
about
high.
him joining the podcast. I would like that. That would be a good
You know
day.
what? I think he does smoke.
Yeah.
You think he
Oh,
smoke?
dude,
Wait, you're
definitely
allowed to smoke as a CEO of a Fortune 500? Like that's
I mean, just a joint here and there. I mean, Elon smokes like nobody cares, right? So
but he's
it's like-
Elon. Right?
Dude, I would be very surprised if Sham wasn't doing a couple of lines of coke before.
my
before a
goodness.
meeting. He's like,
No.
all right, let's go. Let's go.
Not
Connective
Sham.
tissue, baby. Let's go.
Let's invest in
Let's-
all these SPACs. Let's do.
Let's go.
Sham is too focused. I doubt it.
You know, no, Sham is definitely tripping on Addies, bro. He's like popping Addies, like, all right, let's go. Let's talk about this connective tissue, man.
All right, here's Carp.
To get bombarded by various software products. Has
Hey, turn the
software
volume
ever
up.
Been used in the battlefield.
Did the volume? Oh, there it is. Okay, got it. Okay, good.
You're going to get bombarded by various software products. Has the software ever been used in the battlefield? Should be the first question. Software is not a theoretical thing. I spent the first part of my life as an academic. There are a lot of theoretically relevant questions. The first question in a software context is who's used it? How have they used it? What are the results? You can't, these things take 5-6 years to build if you're very good at it. And you need access to the battlefield. Like you can't build these things in a lab. So one of the advantages, quite frankly, we've had is we've been on the battlefield. Why have we had that advantage? It's one of these bug feature things because everyone in the Silicon Valley was bereft of common sense. They were busy exporting things to adversaries and corroding our system with carcinogens in the context of the consumer internet. So we got access to the battlefield.
Now, this is really cool because this was a point. I'm actually doing a video on this tomorrow. This idea that Google, one of the biggest tech companies in the world, Facebook, Amazon, all of them guys, Snapchat, their goal for the past 2 decades was to figure out how to get 1 billion users, 2 billion users, whatever, and then monetize the crap out of all of their attention with ads. And as a result of that, Palantir is one of the only tech companies that spent the past 15 years failing to come up with software that not only protected civil liberties, but obviously was operational on the battlefield because the big guys and Google, as a result of not accepting Project Maven, just decided to ignore it because their search business was doing so well. So, I mean, what do you guys think about that concept of because the consumer internet was taking over, Palantir got an opportunity to essentially have a monopoly on building real battle-tested software, and that being a potential S-curve of military AI applications because maybe ChatGPT is not the AI revolution. Maybe it is operationalizing it on the battlefield.
I think there are points where they should have pivoted a little bit early on in their business, but they chose not to because they wanted to focus on this. Like there's a level of patriotism that Palantir has that not many other companies do. Like it's hard to be Palantir when it comes to like, think about it this way. They work their butts off to try to get all these clients to show off their products, do all this other stuff, but they've never lost focus with trying to support America and the Western interests. Like they could have easily said, you know what, screw this government shit in 2012. The government barely is trying to change themselves. We don't need to work with them. We can just create commercial products and sell them to the enterprise. And that's it. Don't worry about the government. Screw the government. But they never did that. They stayed with it. And there's a level of like patriotism that this company has that not many other companies do.
But they also knew it was good business. They also knew government revenue was sticky. I mean,
no. Government business, dude. I'll be straight with you guys. Government sucks to do business with. I
but
know
just
a lot
having that, Chris.
No.
I'm
telling you,
$3.6 billion of deal value. Like
they had to fight all the way through their entire existence to get that little piece of the pie. One of the reasons why you have a lot of SaaS companies don't want to work with the government is because these guys always have like these onerous contract terms. They get paid irregularly. Like, dude, you can't, if you're trying to be a government contractor is very difficult. Like, look at the largest software vendor for the government right now. It's Leidos, right? Look at Leidos and what they're trading at and how much money they're getting revenue from the government. It's crazy. It's if you saw that, the valuation, like, it's just terrible. The return, the margins are horrible. So government is not the place that you typically want to be, but their sense of patriotism has never waned, which is, I guess, a good thing because the US definitely needs someone to do that. The only thing is, how does it impact the commercial side? You know, that stringent focus that no matter what product that we build, there has to be a situation where that product, the use case originates from like the military context. You know, like I don't know. I don't know.
I think the thing is, like, we have to understand that majority of the tech that consumers and the commercial side gets all comes from military-based testing. So anything you currently have, GPS, all these Tinder apps, finding mates, all that crap was existing because of all the tech that was actually advanced and then testing was done in the military side. So Palantir having that advantage at that top, allowing it to scale down, commercial is a bit of a joke compared to what they're doing in the military side right now because the actual product is being required. So that should be the conviction rate of a lot of people to realize. But I'm just let me like I'll give you another example. SpaceX, we can come out and say, okay, it's hard to get into government, but if you get in the government, and we all know the budget of DoD, it's not small, it's huge. But if you get in the government, like Carp said, 2 years from now they'll be talking about the revenue from the government that is never going to go away, which is ideally never going to go away. So you're always not going to have an issue with money, and with that funding that you're getting from the government, you can continue to grow your commercial side. Example of the Model S for Tesla.
It's a good point.
Sold the big models, came down to the Model 3. SpaceX launched the most complicated problem with reverse landing a rocket, and now you got all these contracts. Peter Thiel and Elon have been known to do the complicated things from the beginning so they can do the more simple things later. That's how you scale a company. You don't scale a company by selling steak dinners, as Carp says, and making a product so easy to sell, because that only goes certain length. You can't go too far with that. You have to do the complicated things. And the whole 0 to 1 book is all about solving the problem that nobody else is solving. And government is that problem. It was very hard to get into them, and that's why they're getting in there.
And I think building on top of that, I think one thing that people don't like to think about is, and this is, I get the Palantirians are going to be very upset with me by saying this, but this is more Silicon Valley-esque than I think a lot of people will give them credit for, is so many of these companies have tripped straight on their face, but you don't remember the failures because they've been so successful at the things that they've been successful at. Think about how many divisions Google has shut down over the years from their ventures. Think about how many products have failed from Apple. Think about how many products have failed from Microsoft. But people don't remember that because now they're doing Microsoft 365 and it's making them however much, and they're doing Azure and it's making however much. These companies have been around for 40 years. They've tripped and fell on their face where they were selling PCs. Then they've completely transitioned to cloud and things of the like. Amazon didn't stop at selling books because they were making good margin. They were saying, well, we could sell books and look how well we're doing. What else can we sell? And they failed and they failed and they failed, but they continue to focus on something and hyper focus on customer satisfaction. And Palantir is no different. Their goal is obviously Western success, and that, you know, is allowing them to have that ability to fail and fail and fail. And I think somebody said it perfectly in the chat, is like, you have the ability to fail, but the biggest thing about companies, which I think sometimes people don't realize, is like companies that are in their maturity are just focusing on reaping as much profit as possible. But when you stop really focusing on continuing to grow, continue to innovate, is really when the company starts to die. And you're giving Palantir that ability to figure out, hey, this is something that we can scale and we can make profit from this, but we're still going to create Meta Constellation. We're still going to create these other products because that's why we're here. We're here to help the West succeed. We're here to create software for the modern enterprise that people aren't willing to do, right? People aren't willing to sit with 40 different industries and say, how can we help you create whatever software that you need to be as successful as possible? And it's the modern transition of what Microsoft did. Microsoft created a product, of suite of products that were able to help the enterprises back then. But it's gotten to a limit, which is where Palantir has now come in and been like, what can we do to create customized software? Not something that's ready off the shelf that you can just plug and use for something that might be good for something that's a round hole, but here's a square peg that you might be able to get 80% of what you need. Palantir is like, no, we want to give you 100% what you need, and we'll literally sit with you until we get it. And anyway, so
and
I love that little clip that you played. It kind of gets you to think they're so different from the Patriot perspective and how they're kind of operating now versus where they kind of came from, but they're still at their heart Silicon Valley-esque, because all these companies had their renaissance moment, like Palantir is kind of going through at this moment.
What's
Yeah,
interesting
hold on,
is
real quick. Building off of Grogu and Matt, and then Chris, I'm gonna let you respond. I'm gonna be really quick on this. That also is, I think, going against your point, Chris, about government is whatever. Like, they are the only company that is actually true to that mission. Like, when Carp says we're here to protect the West, he's not bullshitting. He's not saying that for play. He actually means that. That has to translate to business value. Like, I think based on all the analysis Grogu and Matt just gave, that idea that you are actually there to protect, that's why you didn't work with Russia and China, that will lead to business value. It will subsidize the commercial growth, as the Tesla example Grogu just gave. And that has to be something that is a part of the moat, just based on the fact that the philosophy that they built the company with is so endearing and patriotic, as you said, that even if it's not the deal value, it is the ability for them to grow while they have that sticky revenue on the side that I think makes it attractive to still work for the government.
So I would say historically, if you go back into the 50s, 60s, one of the things is majority of Silicon Valley was actually developed because of government funding in military stuff, right? So if you look at the transistor, the Silicon Valley is what it is today because all of the spending that the government did on military hardware and literally the space race. So there's no denying that early starts for most successful industries have typically come from the government side. The problem that I think Palantir ran into in the 2000s to the 2020s was that they ended up supporting the US government during a time when there was still a lot of controversy surrounding all the military stuff. Like I was in the military. I saw the dramatic drop. And this is what happened in the early years of like 2001. If you said anything anti-patriotic, bro, people came after you like there was no tomorrow. And then towards like 2010s and 2011, I remember people were just like anti-war everything. And by 2017, 2018, it was almost like if you support the US government, you're supporting baby killers and child killers. Like literally, oh, Palantir's that company that helps target innocent children in Afghanistan using Predator drones. Like that's what ended up happening. Right now, I think this is going to sound a little bit kind of cruel, but it's the truth, so I'll say it. We're going back to a world where we know who the bad guys are. We know that the Russians are the bad guys. We know Chinese are the bad guys. And I don't think that's an undeniable fact, whether you're a Democrat or whether you're a Republican. Like, we need enemies. And guess what? Palantir is on the forefront of fighting these enemies. I think when Palantir was around trying to defeat terrorism, it almost felt like Palantir was supporting the unjust occupier in Afghanistan and Iraq, because a lot of people felt that way, right? Even people in other parts of the world. Now the U.S. is like starting to like get its mojo back on the international stage, saying, "Look, at least they're helping defeat the Russians, helping defeat the Chinese in certain regards." We're getting back to the point where we're the heroes again, and Palantir is, because of their affiliation with things, they're the heroes, right? And hopefully that translates into once again an industry that's supportive of Palantir going into the future. But I do agree with you, Grogu. A lot of companies got their start working with the government, and Silicon Valley kind of deviated away from that, where before you needed a lot of money coming in from the government in order to get your company started up into a point where you could make a commercial product. But that all kind of flipped the script after like venture capital really took off in the 2000s, where now you didn't need the government to come in and, give you that early business. Instead, you had these venture capital firms do it. And of course, the enterprises where you could scale. So a lot of companies benefited from that. But I think we're probably transitioning into a world where you have money from both the government side and you've got money from VC funds at the same time. So there's a lot of capital for new development and new industries. And I think that's one of the things that we should all be bullish on going into the future, which is literally there's a lot of capital sitting on the sidelines. So if people have good ideas that are worth pursuing, like in the next 5 years, I think there will be more Fortune 500 companies that get developed than a lot of people are realizing. And it's going to be, and I think the industries that are really going to be there are things surrounding space. I think space is the next big thing. AI is the next big thing.
But see, that's the thing. If space, AI, defense, these are the next big things, and then Grogu, you can go. I feel like Palantir is that prime candidate.
No, that's exactly my point. That you want to be invested in a company that has its tentacles
Why
already
aren't you
in those
invested
industries.
in the company then,
Huh?
Chris? Why aren't you invested?
Well, I am through my wife now. You know, my
No,
wife
not your
has been a-
wife. We need your, you know,
I'll be
100,
honest, I'm
200
making too
grand
much
that-
money. I'm making too much money, bro. I'm making too
You're
much
making
money.
it on that
this.
consumer internet shit Carp was talking about with Meta. He's calling you out on this.
See,
Yeah.
I'm gonna carry on with what Chris said because he makes a point which I'm like that inspired me to talk more about this whole government thing. I think a lot of people are missing out on the point that data requires governance. Now, I'm coming from crypto. I know about regulation, what these guys are talking about, all this how we test and everything being a security. It goes on and on and on. So this regulation part is also an issue for companies like Tesla or any financial company. PayPal or Square couldn't do business anywhere else. They first decided to just stick Cash App only in US because it's hard to get governance around other countries. PayPal had the same issues. Some companies just cannot scale into other countries because of governance. And what they try to do is even Coinbase, another good example, they stuck to US at the beginning because they said if we get our grounds built in the most complicated, regulated country, this or Germany, one or the other, then we can just take that and just go anywhere else after. Where companies like Binance said, fuck off US, we're just going to do everything in China. So if you have a layer above that with something like IL6 that allows the business to scale while connecting to the government side and the commercial side, you're regulatory already compliant without needing to fill out all the paperwork because you have a system set up. This launches a brand new chain of new businesses that can be launched internationally versus what we currently have, because we know how bad it is when it comes to regulations within businesses, like how hard it is to actually launch your business. So I'm also looking at that. A lot of people are not connecting these two dots together, why this IL6 continues, why other companies can benefit from that. So just would love to hear you guys' thoughts on that.
Yeah, I mean, I think Chris and Matt, you kind of both have spoke on it. I mean, I can go on this and then we can wrap up the pod. I think governance, Grogu, I learned from you, obviously, because we had private conversations, and governance is a big deal. And crypto is all about governance. It's all about how can we make sure everything is secure and safe. And we've seen a lot of hacks in crypto because there's lack of governance. Coinbase, I think, is going to end up being a big winner in crypto simply because they have some of the best governance. So Palantir offering that governance of data to the commercial world and to the governmental world. I mean, even Carp in the early days talking about how the CIA and the FBI can't see certain types of data. And so the philosophy of governance needs to be embedded within the technology to make sure they can't cross-collaborate on data they're not supposed to see. That's a big deal. And going back to Matt's point, there's not that many companies that actually cared about that enough for the past 2 decades other than Palantir. And that's where I see our 0 to 1. That's where I see our monopoly. That's what's resulted in the IL6 over every other company that could get it besides Microsoft and Amazon. And that's why it's exciting. It's definitely exciting for sure.
When Lambo,
I don't know, man. When Lambo, I don't know. But look, at the end of the day, we can't get ahead of ourselves. Obviously, $10 was good. Can you guys just talk to end the pod how you felt about $10? Did it tickle your wickle or anything?
as
Like, it felt good for me seeing it. I was just like, this is cool. You know, it's nice.
I think it's a bittersweet, right? Because it gives you a little bit of confidence, but at the same time, it's like I still kind of wish it was $6. I would like to get to 5,000 shares. That would be pretty dope. I never thought I'd get above 2,000 shares, but the portfolio continues to grow, so I continue to have like a little extra cash to throw at Palantir, and this buying opportunity over the past, I guess, year has been really good to be able to purchase under, direct listing date prices. So it was kind of cool to be able to see it get past 10, which is what it direct listed at, right? So it was kind of cool, but at the same time, I feel like it can just as easily go back down to $7 before it goes to 15. And so I think some people are getting ahead of themselves, but I think it's also nice to see that it can get back to double-digit stock prices. And we know that when things go in the right direction, and at least now it sort of feels like there's a little bit of a community. It kind of feels like, how do I say it? Although I feel like the sentiment's a little bit worse when Tesla was in this position in like 2017, 2018. It's like it feels like now people have started to kind of wake up to the potential of Palantir, whether or not it's just for clout reasons or what have you, but it does make it feel like a little bit of what Tesla was kind of going through back when they started to finally start to make some cash. and become profitable. Although I do still think that there was a lot more bears on Tesla back then than it seems like there are maybe on Palantir. Maybe it's just my optimism because I'm in the stock. But it's nice to know that if we continue to go down the right path, that we'll eventually get back to the 20s, 30s, 40s, in due time. I'm not saying tomorrow. This for me is always a long-term hold, the 2030 time frame. So I'm anticipating, over the next 7 years or so that we kind of get back to a place where the price is good. But I think $10 might be a little bit ahead of ourselves for now, personally.
I'm in the same boat as Matt. The one thing I hate about Palantir is the fact that there's so much retail in it, because price discovery is very hard to do with Palantir.
What do you mean price discovery?
Because the thing is, like, the market works very efficiently. So if you do good, people are going to naturally buy your stuff and it'll go up and down. But when there's so many retail investors that just invest based on hopes and dreams, sometimes what ends up happening is it throws off the price, and the market tends to, value it really badly. Like, there comes points where overvaluation takes hold, and there's points where undervaluation will come into play. So there's the chance of accuracy in figuring out what the actual price is really difficult, right? I mean, it's good for if you're trying to trade the stock, but it's really bad if you're trying to invest. So the way that I would describe it is, think about like AMC, and they rode that shit up to 300, what is it, $250? You remember that? That could happen at any time with some of these companies right now, because there's so many more retail investors willing to go YOLO into Palantir. So what happens is the price could ride up really high. So you don't know if this is authentic or not. Like right now, we don't know if this ride up in Palantir is 100% justified, or whether it's just a bunch of retail investors jumping in because the last guy that they were talking to heard that it was going to the moon, so they jumped in also. Now
it was
the
like
question
January
is
2021 when it went to $38 and then $45 in their day.
Yeah, and then at the same time, retail is also not the type that typically holds for a long period of time either. So what ends up happening is things, when they correct, they overcorrect, right? So that's the other thing too. So when you're trying to invest in a company, it's really hard. When you're trying to trade a company, Palantir is a perfect example of company that you can trade very successfully, because all you have to do is just buy some longer dated calls and just wait until literally some crazy event happens like what we just saw, and then sell those calls and make a killing. And then guess what? Once it comes back down, buy those calls again and ride the fucker up. Like, dude, like I said, I've done very well over the last 3-4 months just doing the same exact thing. Literally just buying stuff, waiting for some crazy runaway thing to just take hold, goes up super high, sell the shit out of it, and then come back. I did that with Snowflake a couple of times already, and it was great. Anytime it goes to like 177, something, I sell it. And then it overcorrects, goes back to the 130s, I start buying again. And then it goes back up, boom, sell it. So like I said, right now, there's just so many good opportunities while retail investors are just jumping in and out of the market, where price discovery becomes stupid, that you can actually make some decent money trading.
Okay. Grogu, any last thoughts? Then we're going to end up the pod.
I'm not too excited about the $10. I'm not going to say anything until we go to the all-time highs and take off to another 10x. So nothing to get excited about, guys. Just
this is why I love Grogu. He's ultra.
Why did you invest if you're just waiting for $10? Like, seriously, is that what you invested for? No,
dude.
you make a bet and you hope that it's a 10x. It's been pretty good for me. Like 3 times in a row, I've hit it pretty nicely, right? So it's been okay. So if this is going to be the last one, I'll take off a little bit off the table if I, want to give myself something, maybe buy new AirPods or maybe buy a new snowboard. But yeah, like, dude, like you don't make money messing around on a daily basis. You can. I've done it. I could easily sit down and trade all day and I'll make money. It's not that hard for me, because that's what I used to do. But what I realized after doing all of that for the last 3 to 5, 6 years is that if I had just held on to the conviction that I had, I would have been way better off. Just based on simple math, but it has to be based on a 10x company that you're holding on to. So it's easy to make a small money, and it feels nice when you make $100, $200 once in a while, because you're thinking you're getting paid. But when you get that big paycheck of that mill that you make from that investment, trust me, that will taste so much better than small money here and there. But
Now
that comes
I'm
with a
kind
lot
of
of risk.
curious because you're kind of like you're kind of more in the lens that I am, and what I continue to think about is if a price was in front of me, let's just say, I'll just throw for example, if $80 stock price was in front of me today, what would I do? Would I sell all of it? Would I sell a portion of it?
But
Right?
the caveat is today or 5 years from now.
Wait,
Matt?
hold on. You're gonna have to explain that. Like, so let's just say you've had shares and then it went up to $80.
Yeah. So like, let's just say, for example, my cost base is like in the 12s or something like that.
Mm-hmm.
Let's just say for some reason we have another January 2021, the stock price goes up to $80 a share within the next 6 months. Would you take a position to sell a part of that, or would you continue to ride it out? And this is the thing that I struggle with myself is like, do you take, because like part of me tries to think, I made money off of covered calls back in January 2021. I didn't sell a share, but my thing is just like, would I have been better selling my entire position, or would I have eventually moved on and never bought back into the stock? Or, you know, like you kind of have those like what if moments and you go down rabbit holes. So my thought process is like, at what point within the next 6 months is a price where you're like, you know what, this is good enough, I'm gonna walk away? Is it $80? Is it $120? Like what would it have to be? And then would you only sell a portion of your shares and play with the house money? Like these are the conversations, and maybe it's a conversation for a different pod and a different weekly.
I can answer it right now. What I usually do with my past investments is that if it shot up too high, I have a threshold set up saying that if it's at a high, I do 80-20, meaning I'm 20% and 80% out. But if I feel like there's still upside, if my price target at the end of the day for Palantir is 250, let's just say hypothetically, not like it's gonna happen. Let's just say, and it goes to $80 or $100, I'm probably gonna take 50% off the table and leave it in cash. And then just let it ride the 50% because I don't want to miss out on other gains, but at the same time, I don't want to risk not having any money because the worst thing you can do in the stock market is that not have any cash available to deploy the money if the stock goes down. And that's when you really feel like crap. And I've done some moves because of taxation that I wish I wouldn't have done. I could have sold more at 45, but I did sell at 45, but not as big of a position. But not because of my conviction. It's just that I have a strategic plan set up for them. I'm all in Palantir. But I also trade Palantir. I also buy Palantir because if it does go down, at least I don't feel bad because it's still a position in a company that I like.
Grogu, what's your price target on Palantir next 10 years?
My market cap target is 500 billion, but that's like 10 years down the road. But that's this is part hopium, man. Like I can't even. I'm only just like the bet that I made on ETH and Tesla. It's the same thing. So if that does, even if it's $100 on 150, it's good enough. 250, great. But I'll probably, you can see me 80% out of the position if it hits 180 to 200. I will only leave 20% in there.
180 to 200 price or billion?
Price, if each stock. So is around let's just say if it's around 200, 80% of that position that I have right now will be taken off the table and I'll only leave 20% in there.
Yeah. No, we're on similar. I think like my downside range, I think is like, obviously you could always go to zero. Every company could, but my thought process is anywhere between 50 to 500. I know that leaves a wide range, but my thought process is going to be about 150 to 500 billion market cap. I think there is possibility for some unforeseen like Chris is talking about, right? Some unforeseen technology or software that comes out where it's just like a complete game changer, and they end up being able to compete with the likes of, say, a Google and stuff of the like, 20 years down the road. But right now, the thing that bothers me, that kind of keeps me up at night, is like we see how vital Palantir has kind of been integrated into our society at this point with what's going on in Ukraine, the pandemic rollout, the pullout of Afghanistan. So we like see these everyday things, but at the end of the day, it's like, why is it only making $2 billion a year? That kind of like is what I kind of come back to. I'm like, it's such a pivotal piece of enterprise software, or like just software in general, maybe not enterprise stuff, but just software that is making such big impacts in our world. And is it because they're not charging enough? Or is it just because it's so select and few the use cases of it that we have yet to get to where we need to get to for it to be a $500 billion company, right?
I think people just
struggle with that
they're
internally.
gonna need it. Yeah, I think people just don't know they're going to need it until they actually figure out, oh, we need it. So give it time, I would guess.
So there's one comment that I'll just make. the same companies that were the largest companies in the year 2000 are no longer the most valuable companies on the planet. Okay. If anything, they're a tenth of what they were. Like, look at GE. GE was the most valuable company on the planet pre 2008. Now it's actually not that valuable at all. It's actually, I don't even think ranks in the top 100 anymore. That is the kind of crazy things that can happen over 20 years. So right now we look at Facebook, Google, Amazon, Apple even as, oh my God, this is a forever company. You never know what the next technology that comes along that's going to disrupt the shit out of that industry, right? Because once you get to a point where you're so successful, you typically take your eyes off the ball, and then companies like Palantir can come in, create products because they're always in this survival mode. Like, I need to innovate, I need to survive, I need to 10x. Whereas Google and all these other companies are like, you know what, I can be mediocre and just live off my cash flows. So one of the things is, right now, there are a lot of companies, especially companies like Palantir, who could be the next big thing in technology breakthroughs that right now we won't know. It's going to be 10 years down the line, right? But my estimates on Palantir would be probably what Salesforce would be worth in today's dollars in 2030. So I would say between 200 billion to maybe like 400 billion, somewhere in that range. So if you think about the market cap right now, which is 20 billion, think about how much money that is in 10 years. Especially if you get to the same scale as Salesforce. Because I think that
I was not expecting you to say 200 plus billion, Chris. That's pretty.
Yeah. And by the way, just so people here understand, one of the things that someone told me like a long time ago, and this always stuck to my brain. And they said to me, Chris, you're a retail investor. You don't invest a lot of money, blah, blah, blah. You don't know anything about the market when it comes to like these big hedge funds. They have the ability to do way more research, and they're going to make way more return than you ever will. And then I spoke to another friend of mine who actually runs a hedge fund. And he's like, I wish I was a retail investor. I was like, what do you mean? He's like, there are so many limitations on me being a hedge fund person and the amount of money that I have to move around that I'm not nimble enough to move them around. I can't just be like, oh yeah, you know what? Here's $10,000 and 10X. Like, he told me he can 10X $10,000 in a weekend if he really wanted to. Like, that's easy to do. It's really hard to 10X like $100 million because there's so many things you have to do with liquidity. So believe it or not, even with Palantir, there are ways that you can 5X without Palantir actually 5Xing via options and all this other stuff. I'm not going to describe it. I don't sell courses. But one of the things
Everyone was asking in the chat, where's your course, Chris?
No, I don't do courses. Bro, if you're making real money doing this, and if you have a real job and you enjoy it, I wouldn't. Number one, I would never want to sell a course, and number two, there's so much free stuff on the internet. It doesn't make sense for me to try to teach you guys something that's so out there already. I have my own methodologies.
Do you think that the normal people are like you, Chris? You are very investigative, and you like to look things. And many of the people, no offense to this, is going to be an attack. In a minute, we'll attest to this as well because he has a pretty good following. They don't give a crap about like a lot of what we say. They just want to be told what to buy and not really have to think for themselves. And I experienced that quite a bit. It's like they just want to know what's the next big stock, right? Or what's this, what's that. They don't actually care about, the fact that we actually get 200 people a week is pretty impressive to me, that they're actually listening for an hour. Most people are just like, listen, funny man, like what's the ticker symbol that I need to buy?
You, Matt. It's because of the beard.
No, it's because you're good looks.
People need to invest based on their own personal emotions and personal like lives and how much money they have. There's so many, like anytime someone tries to sell a course, you're trying to create a cookie cutter product on something that can't be cookie cutter, right? Like what Grogu can invest in and go all in is considerably different than what I can do, right? I have a wife. We're trying to buy a house. Like there's so many factors in my life that literally if I tried to apply the same logic, wouldn't work with Grogu, or Grogu's logic wouldn't work with me. So everyone, that's one of the things you have to think for yourself. You have to do things yourself.
Personal finance.
All we can do is
people always try to remove the personal piece of it all the time.
Right.
I always say, Chris, I always say too, if you need to sell a course, you're probably not good at investing money on your own.
Yeah.
I agree. Because also it's like I've made so many mistakes in the market. I know all you guys have made mistakes, and I didn't do it because I watched the course. And if I did watch a course, I would still make those mistakes because we're all gonna make mistakes. It's hard. It's not easy. Chris has made a significant amount of money over the past couple of months, and he's made a ton of mistakes over the years. But
You want to
that's
know
what
what?
led to
You know what?
being
You
able to
guys
do
want to know what my biggest mistake was?
it. Wait, are
And-
you gonna
and-
tell the story?
Yeah.
Was
it
Are you
Snowflake?
finally telling
Audio?
the story?
Huh?
What's a snowflake?
No.
No, it wasn't probably Snowflake. Wait, Chris, are you gonna tell the story you told me on the phone?
Which one? The one with the oil company?
The one where you were on their documents, your name was.
Yes. Yeah. So,
Okay, boom. This is a big story. This
Yeah,
is a late
so-
night. 234 people here, 12:30 a.m. This is gonna be the last story. Then we ended
Yeah.
out. This is a good one. Go ahead.
So one of the things that I've done in the past, I've done debt investing, especially in markets where there's been a kind of a basically it's distressed debt investing. So you're buying up bonds in companies that are typically about to go bankrupt or close to bankruptcy, and you can actually do very, very well if you can nail it just right. I had a stream of victories that allowed me to just literally 20x my money. I know that everyone's like, wait, 20x? Like everyone's 5xing, 10xing. No, I 20x'd my money. Okay. And it was freaking amazing. I was riding cloud nine. And then guess what? I ended up getting too greedy, got too close to the sun.
Wait,
And
real quick. 20x is how? Can you tell us how many dollars that is? Is that
It was close to like 600K. 600K. So I was significantly up there. Like I even have the court filings have my name like with the amount that I had in there. So basically I was buying a lot of debt super cheap when a lot of people didn't realize it, and literally I wrote them, and then my problem was I got too greedy and I didn't sell fast enough. And because I didn't sell fast enough, I ended up losing a significant amount of money. And the other thing is I also didn't diversify. But I was a young guy. This was like
How old
10
were you?
years ago.
10 years
This
ago.
10 years ago. Right. So I
You're
was
like
like
28.
Yeah. So
So hold on. So there's a company. They were basically going bankrupt. You were buying their debt.
Yeah.
And you bought it on like what, Fidelity or something, like a regular exchange?
Yeah, TD Ameritrade. And
Okay.
Matt might actually know this company, Cobalt Energy. They were involved in Heidelberg, and they actually had dealings with Angola, right? So they were there, but literally the commodities fell off the bottom, like what is that thing called? The oil markets dropped off, so their bonds were trading at a heavy discount, but they had a ton of cash sitting on the sidelines.
Was this in
And they had
2015? Where did it
Yeah,
start to drop?
Yeah, and then they had a lot of commercial debt, convertible debt that was trading like pennies on the dollar. I had made so much money in the past dealing with other bankruptcies that I was like got greedy on this one. It rode up to $30, and
Wait, what
didn't
exactly
sell.
rode up to $30?
Huh? Dude,
What?
I bought something at like I think 7 to 8 cents a share, like on a bond that rode up to like 60s and 70s. And I literally I was up there. So what did I do instead of an idiot like just sell out of my position? I held it into the bankruptcy, thinking that, oh my God, the bankruptcy laws are going to be great. They have all these assets on the side, so I'm going to get paid in bankruptcy. Turns out that didn't happen, because what happened was most of the money ended up going to first lien and second lien holders, and
Oh my
I got
gosh.
wiped out. Yeah. So
you
the thing-
lost money. It's not that you lost your gains. You
Yeah.
actually lost money.
So did you
Yeah,
buy in
yeah.
2015 and you wrote it back when things were kind of getting better in 2015, 2016? Or did you buy in
Yeah.
2013 and you were
No,
got
I
wiped out in
bought.
2015?
No, I bought in 2015 when all the oil, like all of these companies in the oil patch, what happened was they had rode up so much. Now the businesses themselves were making a ton of money, but then the price of oil, because a lot of people ended up going into fracking. What ended up happening was the price of oil came down significantly to the point where they were now hemorrhaging money. So before it was like, oh yeah, when oil's trading at $80, $90 a barrel, you're super profitable. But if the price of oil drops, you're no longer profitable. And a lot of those companies had taken on a lot of debt. One of the companies that had taken a lot of debt was Cobalt Energy, because they did Gulf of Mexico discovery, right? And so they actually had discovered oil. They had a large finding. They had interest in another project called Heidelberg that's also in the Gulf of Mexico that Matt might know. They also had interest in Angola, where they actually had leased a lot and they had found oil there, right? But then there were some political things going on where there was like some allegations of corruption, and there was corruption. Anytime you deal with an African like country and its dictator, there's definitely corruption. So there was some corruption cases going on in Africa at the same time. So there was like a lot of research that had to be done, but literally the company had value in it and their bonds were trading pennies on the dollar. So I was like, look, the minute that oil prices recover, these assets are going to be worth a shit ton. The price is just going to skyrocket again. And I'm going to walk away with the biggest gains in my life. Turns out the oil stayed down longer than a lot of people thought. And then they went into bankruptcy. And once again, I thought, well, guess what? They have all these assets, more than covers the first lien debt, more than covers the second lien debt. And the unsecured holders are probably going to get paid a good amount of money, as in bankruptcy, or they'll get converted into equity holders in a new company. Didn't happen that way. Lawyers ate the shit out of the like. Anytime you go into bankruptcy, let me tell you, those lawyers, they bill like $50,000 an hour. It's like crazy amounts of money, dude. I'm telling you.
How did you real quick, how did you even know to research corporate debt for Cobalt Energy? Like, what were you doing that day? You're like, I'm gonna fucking Google what the corporate debt is for, like.
No, because I was actually studying corporate debt way before then. So I had made a lot of money in corporate debt before. So there was a lot of companies, like, you guys know a company called Intelsat. Intelsat at one time was also trading really low on their bonds, but they actually were they had a long history of being profitable. They had satellites. Like, I don't know if you guys know satellites, like they weren't like low orbit satellites, but basically they provided satellite connectivity to vast majority of like the US government and all sorts of things. So there's a lot that I could talk about for bonds. But let me tell you, distressed debt investing was actually one, and I still do it right now, but I do it a lot more carefully. I don't do it with a significant amount of money. Like, I made really good money on, I'll tell you a couple of things, like Royal Caribbean. I was talking to you guys about that, right? Royal Caribbean was trading 70 cents on the dollar, literally like less than a few months ago. And now it's trading at almost par. I can show you guys what I mean real quick if you have a minute here.
But I think one of the things that people need to realize is, like, assets, and I think it's a key thing to take away from this, assets, while they might be on a balance sheet, for example, what Chris is talking about with Cobalt, they had, let's just say, a price estimate for their assets to be at $60 a barrel, $70 a barrel. So in 2015, when oil prices went down to $28 a barrel, those assets declined by 50%. And so the assets that, say, Chris might have been thinking about were like, let's just say it was $5 billion, went to $2.5 billion overnight. And unfortunately, these businesses are very capital intensive. And so when you have all these liens and credit facilities, like, when your assets kind of deplete by 50%, and now you have to liquidate everything when everybody else is also liquidating everything because oil collapsed from $80 a barrel.
But the logic is, if oil goes up fast enough, then that stuff won't matter. If it just,
yes. So that's the thing. And this is where it's like, it gets pretty interesting. It's like, if we stay at $80 a barrel like we are today for, let's just say, the next 5 years, you'll continue to see oil companies' margins shrink. And that's exactly what happened between 2010 and 2014 when the going was good. Oil price went to $140 a barrel. Then obviously the collapse happened in 2009. And then afterwards in 2010, 2011, things kind of came back to the $80 to $100 range, and it just kind of cyclically stayed there. But like Chris was saying, everybody and their mother got into it because it was so profitable. But you have to think, as you get more and more demand, your margin shrinks, just like with anything. So while people might have been initially making $50 a barrel, it slowly shrunk over time to $30, $20, $10 a barrel. And then eventually, when the oil price collapses like that, there's no margin left to be able to keep things in a profitable business.
Right.
Okay, so what you guys are seeing right now is Royal Caribbean debt. Whenever they build ships, they finance it with debt. They use the money to build the ship, and then they pay the debt slowly over time. So here's an example of Royal Caribbean bonds that mature in 2027. The coupon rate is 7.5. That means per year, they'll give you $7.50 for $100 that you lend them, right?
That's pretty good.
Yeah. Now, here's the thing. That right here trades. So This is an independent
Wait, what
product that
trades? The
trades.
coupon rate trades? What exactly trades?
No,
Or
the bond
on the
itself
secondary
trades.
market. So you could buy
Yeah.
it directly through a brokerage initially for $100 coupon rate. And then depending on the liquidity of the company, if it's doing better or worse, it trades on a secondary market where like you could buy it at say 80 cents or 70 cents on the dollar, which is like that $70 price. Your coupon rate's going to skyrocket, but your risk is also much higher.
Yeah.
Mm.
So if you look at it, this company during COVID, right, was like, oh my God, cruise ships are not making any money. They're losing money, blah, blah, blah. The bonds were trading at 66 cents on the dollar, right? So if you look at $66, so right here in June 22nd, they were trading at $66, 66 cents on the dollar. What does that mean? That means that per year, you're still going to get the 7.5% coupon, but it's based on a $100 value, not based on the 66 cents. So it's almost like you're getting $14 or $15 based on this price, roughly, which is really good, right? So if you look at the yield,
Wait, where did you get that 15
spiked
number
up.
from? Why are you getting $15?
Because right here, the yield on it spikes up. Because what happens is you're buying something that has an obligation to pay you 7.5% interest on a par value, which is $100. But if you bought it on the secondary market, you're buying it for a heavy discount. So literally, if you bought it then, the company is still going to pay you $7.50 for that bond. But remember, instead of buying it for $100, you bought it for 66. Right. So now you're going to make a 15% yield on this company. So what ended up happening was the cruise industry recovered and everyone was like, oh my God, COVID is finally gone. Everyone's cruising again. So the price of that bond shot up from $66 back to almost par again, which was around 100. Right. And then actually traded over because interest rates were super low at the time. So they were trading above par, which is even crazier. But it does happen. Then what happened was, of course, this part was when Omicron came, and then everyone got scared of Omicron. So all the bonds were trading way low again to like back into the 70s, right? This is where I ended up picking up a whole bunch of them on 70 cents on the dollar. And now that Omicron is gone, and if you look at Royal Caribbean, one second. Let me just log into Alpha Spread, 1 second.
This is so fascinating. This is incredible.
I've never done it. I've looked at it before on Petrobras and stuff of the like back in the same time period that you got involved, Chris, but I never pulled the trigger, and I'd be curious where I would be. I know a lot of people that recently, because I work deep water Gulf of Mexico, right? So I work offshore, and that has a lot to do with like Transocean and stuff like that. I know a lot of people that gambled on Transocean, and I was like,
that was the best.
It was.
I'm telling you, the best thing that you could have done. I'll show you guys what Matt is talking about in just a second, because that's worth looking at. But let's do.
But it like with Chris, like it doesn't always work out, right? So the company can go bankrupt, and then you're effed, right?
Yeah. The thing is, it's 1 second. So if you look at Royal Caribbean, this is Royal Caribbean. There it is. So you can see here the revenue started to fall off. Their operating income started to fall down, and literally they were trading at negative. So they were losing money. But guess what happened? They ended up, recovering. All their businesses are starting to come back. Everyone is starting to go cruise again. And now you can see their operating income has recovered again. So now their gross margins, everything is back up. So now those bonds are trading at almost par. Why? Because now the risk of bankruptcy has dropped off significantly, right? So now you basically can, I could sell those for like at $100, 100 cents on the dollar, which is at par. And guess what? I made money from the $70 to the 100. And so I made a 30% return there. But here's the part that I really like. I still get to get that coupon, which is amazing, right? For the next however many years. And Royal Caribbean is back in business. The one thing that, and I'll show you guys really quick what Matt is talking about. Transocean was a drilling rig provider. So basically they owned the drilling rigs that you could lease in order to do exploration and then to do upstream. Now, they had built up a whole portfolio of deep water Gulf leases. Now, they had to take on a lot of debt in order to finance all those rigs, right? So when the oil prices ended up going down, the leases on those weren't renewed by a lot of companies. They were just like, no, this is not going to work out. So the bonds were trading at pennies on the dollar. Let me see if I can find them real quick.
We gotta end it out soon because it's getting late.
Yeah.
This is really cool. This is we'll see you next time on the Gas and Oil Weekly. This is so dope. Corporate Debt Weekly. While Chris is pulling that up, Grogu, any final thoughts on Palantir?
No, I would say take the price more seriously when the 200 weekly moving average price starts to show up, because we don't have that available, only 50. That's usually when proper trading starts to enable for me, because it's just so early right now, right? But I think I'm waiting for that. When 200-day weekly moving average shows up, it's going to be giving me a better idea of where we're at with the price action. But that's all I got for now.
I guess that won't happen until
a while.
What, 2024, 2025?
Yeah, it's going to be a little while. But yeah, that's a good indicator.
Cool.
Okay, so this is one of the bonds for Transocean, like I told you guys with the drilling rigs. So you can see here, this is Transocean. It used to be trading at par because it was getting really good lease rates, doing very well. And then the price of oil drops off. So Transocean dropped all the way down to 40 cents on the dollar, like their debt, right? So they owe you 100 and they pay you 7.5% coupon, but they were trading literally at 44 cents on the dollar. So the yield is around 15. So some people bought it around here, wrote it up, and then COVID happens. Look at what happened during COVID. Oil prices had gone freaking absurdly low. And then everyone thought, oh my God, the bottom's falling out. And literally these bonds were trading at 15 cents on the dollar. Okay. And these are real assets with actually long-term leases that Transocean had. Well, oil comes back roaring. So what happens to Transocean? The price of that bond skyrockets. Now, here's the thing. If you had bought this bond right here at 15 cents on the dollar, you would have got an annualized yield of almost 50% year over year in yield. Okay, because you're buying something that's worth $100 that's yielding 7.5% for that $100, and you're buying it for 15 cents. Okay, which is freaking nuts. So imagine right now your rate of return ends up being 50% per year, guaranteed, fixed through 2031.
That's only if you bought it in 2020.
Yeah, when it was
So
at
you
its
have
low.
11 years of a fixed 50% CAGR.
Yeah, and then in April 15th of 2031, you would get your $100 back, right? So you bought it at say 15. You bought it at $15, and Transocean would say, "Well, we're returning back the cash now. Here's $100." So you'd be able to get all that cash flow up to that point, and then, but it never, the reason why I was trading at $15 was because who knows if it's going to make it, right? Just like how Chris was able to make an investment in Cobalt, and it, was able to kind of skyrocket, but obviously it went back down the other way, right? Where it never came back to that coupon rate, right? And he wasn't able to get, his initial investment back. But it's worth to kind of look at for some of these organizations, because like Carnival and like Boeing, like those were companies I invested in, small investments. They weren't very big because I'm more of like a long-term investor, but I bought calls and stuff in that stuff. And, you could easily just do the same, right? That's what all these companies are doing. They're issuing all this debt, right? That's what Boeing did. That's what Carnival did. They just issue all this debt. That's where their working capital comes from. So it's pretty interesting, and I don't think a lot of people recognize this. And I know, Amit, you're trying to end it because we've diverted, but like when you think about it, if you're like a yield, if you're a yield investor, and I'm going to make a video about this, it's like I think a lot of people are like, oh, 7%, like that's really good. When you have people that are out there investing in Jeppies and Devos of the world that are that are giving you monthly dividends of 5 to 7%, but it's like you can easily just buy a treasury bill right now with very little risk, if any, and get 5% right now. And I don't think people are recognizing that. You can just easily put it in a savings account. Like it's a very different world than what we've been used to over the past 10 years since the great financial crisis. And I don't think people recognize that. It's like the savings accounts, which, keep in mind though, like when the Fed cuts interest rates, more likely in the beginning of next year, those rates will kind of go back down. But if you have, say you're in your late 50s, early 60s, and you're like, all I need is 4 to 5%. you could buy a bond right now for a 30% or a 30-year bond for like 4.5% yield and call it done. That's your portfolio for the rest of your life. And I don't think people recognize that. It's like very little risk, low risk. And some people are chasing these Jeppies of the world. I literally had a conversation with a Deca millionaire the other day. He's like, I'm investing in Jeppy. And I was like, hold on. I was like, do you need this money soon? What kind of risk are you willing to take on? Jeppy could go down 10% overnight because it's an equity, just like anything else. So if you're concerned about risk and you don't want to take on that risk, now you're getting risk-free money for 4.5%, which, 5 years ago wasn't the case.
Dude, in the 1980s, do you know what the risk-free yield was on federal debt at the time? It was like close to like 15%. And there was something that was non-callable. So they weren't even able to unload it. You could get 30 years of 15% return per year every single year if you bought those bonds in the 80s. And it was non-callable debt, which is another thing that was unheard of. And the freaking tax benefit. Dude, you could have retired at the time with a few $100,000 and literally lived like a fat king at the time.
And that's why bonds have done so well, right? So because everyone looks at bonds from the 80s to now, rates and yields have, or not rates, but yields have only gone down from that 15% down to where we were in the great financial crisis, which was 0%. So obviously if you have a bond yielding 15% and now you have something that's yielding 0%, you'll pay out the ass for the thing that was yielding 15% because now you can't get anything that's worth a damn in yield. So we're now kind of getting into this opposite place where yields are starting to finally come back up from zero. So it's like if you bought bonds, which is the problem that I think a lot of people were doing, about a year ago, they're like, I'm buying bonds. And now their bonds are sitting down 30-40% because the yields have come up so fast, so quick that you're getting these new issues. I'm buying, not a lot, but I'm buying some bonds where it's like, you're getting that 4% yield. And it's like, well, why would I buy a bond that's yielding 2% or 2.25% when I could literally buy this bond that's just issued for 4%? Like, it just doesn't make sense. So that's why bonds did so well from the 80s to the 2010s. And who knows where it's going to end up in the trajectory. Unless we go negative, like, I don't think you're going to have a great bull run in bonds like we did from the 80s to the 2000s.
Yeah. So, Chris, is the name of the course going to be called Here's How You 20X and Lose Your 20X? I cannot believe
I need to gamble a little bit with it, man. Like, just put like a couple $100.
Wait,
just give it a go.
We could go in on something together if you want. But
if you had made 600, if you had made 600K, what would you have done? Was that like life-changing money for you?
No, it's never been life-changing.
At that age, he would have still gambled, and he probably would have gotten into more risk. And he probably would have went from 600 to then like a couple $100 million, and then back down to zero again.
Listen, when I was young, first of all, I had bought a really nice condo in the city, so I was good. I had a really good job. My only thought at the time was, I'm going to retire my parents. Like, that was my goal. I was like, dude, I'm going to make enough to the point where my mom and dad would never have to work again. And this will be great. And that's one of the things that I got a little too greedy with, right? Whenever you get to the point where you get that greed in you and it takes away from your rationality. And when you're 28,
600K wouldn't have retired them, right? I mean, you probably need more than that.
Yeah. No, but the thing is, dude, I'm talking about how much money did I was in with 100. I got up to 600. So I was up a lot. And then had I bought a couple of other bonds, which I didn't, I would have been at 1.3, 1.4 million at the time.
Wow.
Yeah.
I'm logging on to Fidelity as we speak. I'm not going to
bed. Chris is around, I think he's around my age, and that's like the dream of like every brown kid. It's just like getting your parents retired. It's like been around. Yeah,
it's fine. It's fine. I mean, you know what? Life is one of those things that you're just gonna have to learn. And I am an old lion that's taken up my fair share of licks, dude. So a lot of people think like, oh my God, Chris, this is just some young guy, bro. I'm not young. I'm old. Now I told you guys,
38 is relatively young though in this era.
I guess, yeah. Whatever, but basically one of the things that we have an advantage over with a lot of institutional money is that we're small and we're more nimble. The benefit that they have is they have lawyers. Let me tell you, when I was in the bankruptcy, I actually went to Texas at the time, and the lawyers are fucking killers, dude. They literally will go through everything with a fine-tooth comb. corporate debt specialists, like lawyers, they make a fuck ton of money. Like they make so
Yeah.
much money, it's nuts. If you look at their hours billable, it's nuts. And it's literally all they do is show up to court and be like, oh, you know what? We can't present this week. Let's do it next week. And they bill like $10,000, for continuance.
We maintained about 240 people for the past 30 minutes of not talking about Palantir, which is pretty dope because that means they actually cared about the other topics we had to talk about. So that was awesome. Thank you all for being here. This is awesome. Grogu, thank you for joining. I know you don't do a lot of these, so it was awesome to have you on.
Thanks for having me.
Yeah, thank you, Matt, for being here. Thank you, Chris. So I called Chris because he forgot about this because he doesn't care about the show, even though this was his idea. His wife picks up and he's like, I'm cuddling with Chris right now. And I'm like, we need Chris, though. Who else is going to tell us about corporate debt? And so, like, she finally let him go.
Yeah.
And,
now, you know who I'd really recommend you guys check out? Howard Marks. Howard Mark and Bruce Kresh with Oak Tree Capital. They actually, he's like one of my heroes when it comes to, because he used to invest in equities in the 70s. And he's like, I was terrible at it. I sucked at it. But then I got into debt. No one wanted to look into debt. And he made his fortune. He's a billionaire right now. And they all made their money on debt, So.
Got it.
AMC on Fidelity is the highest yielder right now.
I'm not touching AMC. Screw that
nonsense.
nonsense.
I wouldn't either.
Yeah. You
guys
know
want yield. You guys should get
you got
we got 1,000% over there.
You know which one was like the recent one that was really crazy to look at? Bed Bath & Beyond. Bed Bath & Beyond bonds were trading at 3 cents on the dollar. Okay. 3 cents. Okay. Right now, those same bonds.
But they're likely to actually go bankrupt. So that's risky.
Right. But they came in with some last minute financing deal and now they're yielding 30 cents on the dollar, which means you could have 10x your money in less than a month. And literally you're paying for what? You're paying 3 cents. So I could have thrown, let's say, $1,000 and come off with 10,000.
Wow.
Yeah. I'll show you guys what it looks like. 1 second here.
Oh, we gotta go. Whatever.
Have a good night.
We're gonna be until 5 a.m. Like, I'll show you guys. Give me 1 second. Alpha spread. Blah, 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 blah. I'll show you guys. 1 second.
Yeah.
All right. That's great. I gotta go. It was awesome. We can't do this tomorrow night because I'm gonna be in Boston. So I was happy we were able to do it today.
Is it your Valentine's Day?
No. I don't have a Valentine's. I'm committed to the grind, so I don't have a Valentine. But the last week we didn't do Palantir Weekly because I was in Pennsylvania for work and Chris, he was tired, he was a little sick, and so many people were like, where the fuck is Palantir Week? So we're gonna try to make sure we don't miss a single week. Because
what part of Pennsylvania? You gotta message me. You gotta see if you're in my home spot.
I was near Philly, UPenn, around that area.
Yeah.
Okay, awesome, cool.
All right, guys, I gotta go.
We got a comment.
Okay, bye.
Have a good one, y'all.
Take care, guys.
Bye, guys. Bye.
Cheers.
Later.